Parag bhai, if I can first start off by understanding from you how you're looking at the TCS numbers. Also, how are you looking at the read-through of that on other IT, and also this diversion of free cash flow, if I can call it that, towards data centers, AI, and the like. Maybe delayed, you would say? Are they late to the party to a certain extent?
No, so basically, good morning. Thanks
Good
for
morning.
having me on the show. First of all, I would like to make a disclaimer that we have 2.5% weight in TCS, and we are not going to sell at this price. That is our stance. Whether we'll add more, it depends. See, the two, three things which are positive is, first of all, the result was positive, right? 0.8% CC growth, 25.2% margin, in spite of 1 month of wage hike impact. Deal wins were very good, $10 billion. Plus a commentary that project cancellations and deferrals have stopped. H2 is looking better. So I would say that considering the fact that stock is now trading at only 20 times FY27 earnings, expected EPS of 150 rupees, I would not sell the stock for sure. Now coming to your thing on AI investment, data center investment. See, data center, I will say that 1 gigawatt, which is $6 to $7 billion over next 5 to 7 years, and that too with a partner who will be investing equity also, and they'll partly fund it through debt also. So I would say it is not a big strain on a balance sheet which has 50,000 crore cash already. Plus, it generates 50,000 crore of profits every year, which is free cash flow. So I don't think one should look at from that perspective that free cash flow is getting diverted. When Infosys did buyback, people said that Indian companies are still rewarding shareholders by doing buybacks while others are investing. Now, when TCS is investing, you cannot have both views, right? Either of the two can be right. And in my view, I feel that every company has their own way of choosing where they get maximum value. In my view, if TCS is able to showcase good execution there, if they are able to tell to market that who are their main clients, whether the entire data center plan is completely being booked or leased out, those things are very important. Plus, it will improve the stickiness with the relationship with their customers like AWS or Salesforce, because now they are investing in physical infrastructure also for them, not only providing services. So I don't think that any of the decisions are wrong, and so I'm not a seller for sure.
Okay, got Rajesh Bhosle as well joining in to talk about what he's making of the charts right now. And Rajesh, let's switch out of IT and let's talk about banks firstly. The good news is that for the last 3 days, we've been seeing FII buying. Day before, though, was a minuscule figure. I don't know whether this is a trend in the making, but surely, that money will find its way to large cap banks firstly. Tell me, what's your reading on the Nifty Bank?
Good morning, and thank you for having me on your show. Yeah, so the Bank Nifty has been an outperformer. While we see Nifty hasn't crossed its September swing high, Bank Nifty has already crossed its September swing high. Last couple of session was consolidating, but it was holding on to its 89 EMA, and now we are seeing that the upward momentum has continued in the last session. So we expect prices to extend towards the 57,000, and any dip would be a buying opportunity. Last 4 sessions, somewhere buying has been happening somewhere around 55,800. So any dip towards 55,800 can be bought, and the near-term target should be around 57,000 levels.
Okay, that's that on Nifty Bank. Just looking at some of the other movers from yesterday. And Parag, it's good to see the way metals have actually come back, right? And I think year to date, it would be one of the biggest movers. How much of the rally do you think is behind us, and whether there are fundamental triggers in place for metal stocks to move higher than here, Parag?
See, stocks generally move in tandem with the metal prices, right? So we have seen that Hindalco has moved from say 650 to 770, and aluminum prices on LME has also moved from say $2,500 to now closer to 2,740, $2,760. And see, one of the reason is weakness in dollar because we are going to expect rate cuts in US. So basically, one of the good reason is dollar index falling, and the other reason is of course China putting cap on its capacities. For example, in aluminium they don't produce above 45 million tons, and of course in steel safeguard duty and all has protected Indian steel companies. So I am constructive on the sector, overweight on the sector, and with large position in Hindalco and some position in Tata Steel. And I would like to hold on because in Hindalco I see multiple long-term triggers. Like they've got the coal mines in place now, which will increase their aluminum EBITDA per ton over next 2 years. The Novelis new plant will start next year, where the average realization will improve significantly. That is what they have guided, $600 per ton EBITDA. So I would like to hold on to Hindalco and Tata Steels of the world in metal space. And just to come back to your banking thing, I think on this Saturday, HDFC Bank, ICICI Bank will report the numbers. What I feel is this is a bottom of the margin. Maximum margin contraction, which I expect on core basis, is 5 to 9 bips in both cases. From here on, due to GST cut-led surge in demand, the credit growth is only going to increase. Margins will also gradually inch up because of deposit repricing and CRR cut. And I'm seeing a very fantastic new next year for banks like HDFC and ICICI and SBI also, which have a pristine asset quality track record. And one of the things which I would like to say is ECL provisioning, right? And that has been a point of discussion after RBI policy. There also a prudent bank like HDFC Bank has done a huge contingency provision. When they came out with IPO of HDB Financial Services and raised 9,000 crores, instead of booking it in PNL, they did a contingency buffer, which will come to help if they have to do any provisioning on ECL front. So that will also protect them. Plus valuations at 2 times price to book, 15 PE is no longer expensive. So I would say that we have a very large weight in HDFC, ICICI and SBI in our portfolio, and we would continue to hold on.